Intel just released their latest quarterly figures, a double beat for the quarter as expected. It was pretty easy to beat the guidance that they gave us, so okay, we'll give them that. The problem here is it's down 5% after hours because guidance was quite weak. So Q2 is expected to be yet another very weak quarter across the board. They gave us a couple of explanations, so let's touch on all of that. Yes, my voice is a bit strange. I think I have a cold, but fine. We'll survive. The markets are green, so we'll survive. By the way, if you missed the Google earnings review, that will be in the top right corner. Right now, we are basically back to prices not seen since Wednesday, because in the last 5 days, Intel stock is actually up 13% or so, but now being down 5%, so we're back to prices not seen since, well, 2 days or so ago. Now, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so I first start with some commentary from Lip Bhutan, of course, the new CEO for Intel. I mean, there were some things here that will blow your mind. First up, the first quarter was a step in the right direction, but there are no quick fixes as we work to get back on a path to gaining market share and driving sustainable growth. I'm taking swift actions to drive better execution and operational efficiency while empowering our engineers to create great products. We're going back to basics by listening to our customers and making the changes needed to build the new Intel. Now, when he went back to ask, well, the customers what they think about Intel, well, they said the following. So the feedback I have received from our customers, and many of you have been consistent, we are seen as too slow, too complex, and too set in our ways, and we need to change. Our flatter executive team structure that I shared last week was a first step. The next step is to drive greater simplicity, speed, and collaboration across the entire company. To achieve these objectives, today I'm announcing some important changes. Flattening the organization. As we focus on engineering, we will also remove organizational complexity. Many teams are 8 or more layers deep, which creates unnecessary bureaucracy that slows us down. I've asked the ET to take a fresh look at the respective orgs with a focus on removing layers, increasing spans of control, and empowering top performers. Our competitors are lean, fast, and agile, and that's what we must become to improve our execution. A bit like what Meta did a couple of years ago. And by the way, a couple of days ago, I showed you this. This is the amount of employees working at Intel, and these are the amount of employees working at NVIDIA and AMD. Now, yes, of course, Intel has Intel Foundry, so of course it will need more employees than an AMD or an NVIDIA. But NVIDIA and AMD combined still have around 40,000 employees less than Intel. This just doesn't make any sense. Now, it would make sense if Intel was still on top, right? If Intel was worth $1 trillion because they're still the king of the semiconductor space, then okay, maybe it would make sense. But currently, they're so far behind that I don't see why they need so many employees. And clearly, Lip Bhutan agrees with that statement, and this is the most mind-blowing thing I've read today. I've been surprised to learn that in recent years, the most important KPI for many managers at Intel has been the size of their teams. This doesn't make any sense. None whatsoever. Going forward, this will not be the case. I'm a big believer in the philosophy that the best leaders get the most done with the fewest people. We will embrace this mindset across the company, which will include empowering our top talent to make decisions and take greater ownership of key priorities. There is no way around the fact that these critical changes will reduce the size of our workforce. As I said when I joined, we need to make some very hard decisions to put our company on our solid footing for the future. This will begin in Q2, and we will move as quickly as possible over the next several months. We are going to be very intentional about where we focus these efforts and how we stack up against the best in the industry. We have learned some valuable lessons from past actions. We must balance our reductions with the need to retain and recruit key talent. I will empower each of my leaders to make the best possible decisions aligned with our top priorities. These decisions will not be made lightly, and we will keep you regularly informed. Basically, what Intel is going to experience is a Doge-like restructuring. And as I said in past live stream as well with Jose, Libutan, I do think that he's the right guy for Intel at the moment. Pat was crucial for the last couple of years or so to turn the ship in the right direction, but he did not want to make that last necessary step, which is cutting even deeper. And I think that was the big disagreement that happened between, when Libutan was actually on the board of Intel a year and a half or so ago, then he left. I think he wanted more drastic changes at Intel. That didn't happen. And I think that's also why Pat left or was pushed out of the company, and why Libutan is now the CEO. I think he's the right guy for Intel at the moment. Of course, this will take more time than previously expected. And so, finally, Q1 results. $12.7 billion in revenue, down 0.4% year over year, and around $500 million above their January outlook. Gross margin of 39.2%, down 5.9 percentage points year over year, and 3.2 percentage points above the January outlook, and EPS of 13 cents, down 5 cents year over year, and 13 cents above the January outlook. And so looking at CCG and DCAI, by the way, there was some restructuring the way they're reporting, so NAX is now included a little bit in CCG and DCAI as well. Now CCG here, revenue was $7.6 billion, operating margin of 30.9%, so that did come down quarter over quarter and year over year. Client results in line with expectations on higher volume offset by product mix and competitive environment. Whereas DCAI, revenue came in at $4.1 billion, that's an increase year over year, and operating margin is also up 13.9%. Data center better than expected on hyperscaler AI host CPUs and storage compute. Now they gave us a little bit more information here. So Q1 saw strong hyperscaler demand, but Q2 is expected to decline sequentially. Optimism for the second half driven by upcoming products like Granite Rapids and Xeon 6, which support traditional consolidation and AI head nodes. Strong demand for older generation data center parts exists alongside demand for newer ones. The goal is to stabilize market share, improve margins, and increase ASPs, focusing efforts on the rest of the world segment. As for CCG, Q1 was below typical seasonality. Demand for older generation parts like Raptor Lake on Intel 7 is currently stronger than expected for newer products like Meteor and Lunar Lake, attributed to macroeconomic factors and OEM efforts to meet consumer price points. And then as for Intel Foundry, Q1 revenue $4.7 billion, up sequentially due to Intel 7 wafer pull-ins and advanced packaging. Operating loss of $2.3 billion was flat sequentially as structural cost improvements were offset by Intel 18A ramp startup cost. Building trust and focusing on customer service are key priorities. So all in all, this is what you get. Definitely not a pretty picture. Now, of course, we have seen worse, right? Back here in 2023. Since then, Foundry revenue has been flat-ish. So, okay, flat-ish and not declining. We'll take that. The data center and AI one is, well, increasing a little bit more recently. But again, you would have expected something much, much better than that. And then the client side of things, well, that's, I guess, the silver lining at the moment. Although I think it could have been much, much better. Looking at Q2 outlook, well, they're giving us a greater range than previously expected, a wider range, shall I say. So they expect revenue to come between $11.2 to $12.4 billion, gross margin 36.5%, and EPS basically coming in flat. They did talk a little bit more about cost reduction and efficiency. So new targets for non-GAAP operating expenses are set at $17 billion for 2025. That's down $500 million from the prior target and $16 billion for 2026. As for gross capex target for 2025, that's reduced to $18 billion, down from $20 billion, reflecting increased operational efficiencies and better utilization of existing assets under construction. This leveraging approach is expected to continue into 2026. Long-term capital intensity is expected to be around 25%. As for the AI strategy evolution, the strategy involves a workflow-first approach, partnering to build purpose-built silicon and software. Focus is going to be on emerging AI workloads like reasoning models, agentic AI, and physical AI, particularly in edge and inference computing. requiring architecture optimized for low power and efficiency. Of course, there is, I'd say, no point for Intel to try and catch up when it comes to training. I think the focus is definitely going to be on inferencing and inferencing on edge from here on out. They of course talked a little bit about the macro uncertainty and tariffs and how that might impact and how that is impacting their outlook for Q2 and for the rest of the year. I expect more of those comments to come from other companies out there that have reported weak results. Now, to touch on the next couple of things here, Intel 7, Intel 18A, internal, external mix, etc., etc. So capacity is constrained due to higher than expected Raptor Lake demand when it comes to Intel 7, which is currently outpacing some newer models. When it comes to 18A progress, Panther Lake is tracking well on Intel 18A, with the first queue expected by the end of 2025. Startup costs for 18A ramp are impacting Foundry margins as expected. Then, when we talk about internal and external mix, there have been more reports coming out in the last couple of days and weeks. So the goal of bringing around 70% of die manufacturing in-house to 18A remains. For Nova Lake, the approach is SKU level optimization using both internal Intel processes and external foundries like TSMC, with more wafers built internally than for Panther Lake. Maintaining external capacity is part of a smart capital strategy, makes total sense, and I think business-wise, it is very smart. Last thing here, IDM rationale. While acknowledging the success of other models, Intel aims for a balanced IDM approach where its foundry serves for both internal needs and external customers, focusing on efficiency, yield, and strong partner relationships. So there you have it. I do expect maybe another client announcement in the next, let's say, 12 months or so, maybe strategic partnership as well. Quickly touching here on Mobileye, because they also reported earlier today. So Mobileye on a GAAP basis here, revenue increased 83%, gross profit is up 283%, gross margin is up 2,467 basis points, basically going from 23% to 47%. Operating income, operating margin, still a loss here, but a big improvement year on year. Same for EPS, basic and diluted. When you look at non-GAAP, if we look at adjusted operating margin, that's at 13%. And if we look at adjusted net income, that's $63 million, up from a loss of $55 million same quarter last year. They did also announce a couple of extra things. So they announced their first surround ADAS win with the mainstream brands of Volkswagen Group. There was also an announcement, Volkswagen and Uber, to roll out some fleet, I think starting in 2026, of course, with the help of Mobileye. This program is strategic because it cuts across Volkswagen's highest volume platform and supports both next generation safety and cost efficiency highway hands-free driving. It is also the first time an OEM has sourced a level 2+ program in which the software stack, including perception, mapping, driving policy, and driving functions, are vertically integrated by one supplier on a single system on chip on an ECU. And so all in all, that's about it. Do I plan on selling any shares? No, I do not. But I also do not plan on buying any shares anytime soon, because I do think that my cash, whenever that will be available, can be put to better use with other companies that have, more catalysts in the near term. So all in all, that's about it. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, go check out the Google review at the top right corner, and I'll see you all in the next one. Bye bye.